Global markets were jolted from their complacency in February, and the S&P 500 experienced its worst day since the US ratings downgrade in 2011. The catalyst for the sell-off was surprisingly strong US wage growth, which had the market participants concerned about rising inflationary pressure. Markets are now pricing in a 40% chance of at least 4 US rate hikes this year, up from a 12% chance at the beginning of the year. The VIX index, which can be loosely interpreted as a gauge of market uncertainty, spiked to levels seen only a handful of times in the last decade. The US dollar finally found some support in February after being under pressure for most of the last year. Its haven status and increasingly attractive yields drove it higher, while the uncertainty around upcoming Italian elections and Brexit negotiations, which remain fraught with complexity, put pressure on the euro and the sterling. As US corporates wrapped up their fourth quarter earnings announcements, the trend of strong earnings growth into year-end continued and was enough to help the markets recover some of its losses. Large US tech companies were again responsible for some of the biggest earnings surprises and helped the S&P 500 tech sector end the month as the only sector with a positive return. Increasing US shale oil supply caused a pullback in the oil price and left the S&P 500 energy sector down over 10% for the month. Rate-sensitive sectors like consumer staples and real estate were also laggards in February, with real estate companies experiencing a particularly bad year, caught between rising interest costs and slowing growth as commercial properties reach peak occupancy levels. Emerging markets were also weak in February, though commodity exporters fared best. Commodity companies are generating decent cash flows at current commodity prices. If you have any questions on this or to invest with Anchor, please contact us on sales@anchorcapital.coza or visit our website www.anchorcapital.coza.